A tremor is shaking the private credit market as one of its biggest players faces unprecedented investor withdrawals. This signals growing concerns across a trillion-dollar industry. Investors are pulling money out of Blackstone's flagship private credit fund, BCRED, at an unprecedented rate. In the first quarter of this year, the fund saw redemption requests totaling 7.9% of its shares, or roughly $3.7 billion. This isn't just a large number, it's a record for BCRED and a clear signal of mounting investor anxiety within the rapidly expanding private credit market. This move could resonate across the entire financial landscape, making every investor pay close attention. To understand the significance, let's define private credit. At its core, private credit involves direct loans made by non-bank lenders to businesses. This market emerged prominently after the 2008 financial crisis as banks faced tighter regulations and reduced their lending to middle-market companies. Institutional and individual investors poured billions into these funds, seeking higher yields and diversification. The U.S. private credit market alone has surged to an estimated $1.8 trillion, reshaping how companies access financing. This growth was particularly fueled by its ability to offer flexible, bespoke financing solutions.
So why are investors suddenly hitting the brakes? Several factors are at play. Firstly, there's growing anxiety over valuations and the overall credit quality within private credit portfolios. Higher interest rates, notably the Federal Reserve keeping rates between 5.25% and 5.50% as of mid-2024, have significantly increased borrowing costs for companies. This strains cash flow, raising the risk of defaults, especially for highly leveraged businesses. Additionally, a substantial portion of private credit loans are exposed to software and technology firms, which analysts believe are uniquely vulnerable to disruption from artificial intelligence.
Blackstone isn't alone in this trend. Other major private credit managers, including Blue Owl and Eris, have also reported elevated redemption pressure in recent months. Blue Owl even permanently halted redemptions for one of its tech-focused credit funds. This highlights a crucial issue for the market: liquidity. Private credit funds, especially those marketed to retail investors, are often semi-liquid. They invest in illiquid underlying loans but offer periodic withdrawal windows. When requests surge, this structural mismatch can create challenges, leading managers to upsize repurchase offers or, in some cases, sell assets. This rush for the exits is forcing increased scrutiny on the entire non-bank lending sector. The news sent Blackstone stock down almost 7% on the day. Looking ahead, analysts are divided on the private credit market's trajectory. Some foresee continued growth, projecting the market could reach $3 trillion by 2028. They emphasize its role in financing middle-market firms and specialized sectors. However, others warn of a volatile environment as the asset class faces its first true test through a full credit cycle. Key indicators to watch include the pace of interest rate changes by central banks and the default rates among leveraged companies. The sheer volume of middle market debt maturing in 2026, estimated at $162 billion, will also be critical, as these loans face refinancing at significantly higher rates than their initial issuance. The current environment underscores a fundamental shift in capital markets. As non-bank lending continues its expansion, the interplay between liquidity, risk management, and investor sentiment will be paramount. Major firms will likely continue to adapt their strategies, potentially focusing on more robust due diligence and diversified exposures. The coming quarters will reveal how well these funds and the broader private credit ecosystem can navigate these evolving economic headwinds.
This is GeeseFinance.